Yeah, in this session, we are going to look out for credit and counterparty risk. Now, we all know that uh, a credit risk is something that can arise because of defaulting on some obligation, or it could also result in a change in a credit rating. Now, there is, in general, in any financial transactions, there are obligations of one party paying to the other a specified amount at a specified date. Right? Let's say in case of a loan, there is an obligation on the part of the borrower to pay the lender different sets of amounts at different points in time. Let's say the interest on a regular basis and principal at the end of the maturity period. So there is an obligation to make those kind of payments, and any kind of a default that is coming on any of those obligations, or even a change in the credit rating associated with the person. For example, the credit quality of a company has degraded. Obviously, the interest rate on the same should increase. But if I'm not increasing the interest rate and the company is paying the same, then there is a risk that is associated. So that kind of a risk is also linked to a credit risk. So typically when we talk about the various types of instruments that fall under the category of credit risk, or where the credit risk typically comes into picture, I can categorize them into corporate debt, where we talk about the loans, corporate loans or bonds, where we talk about the loans that are raised by the companies, fixed and floating rate, the bonds that are issued by the companies to raise capital, again fixed and floating. So here we will be talking about their inability to pay, right, at specified points in time, specified amounts, or even their willingness to pay. So the default that can come out because of these corporate loans and bonds is one major source of credit risk. So from the corporate, there is a possibility of a credit risk arising. Then the next dimension that we should see here is sovereign, more associated with the government borrowings. Could be a central government, state government, at any layer. The borrowings that are done by the government, either by the issue of the various short-term bills or long-term bonds, that whatever is the default that happens on the same, we are classifying it as sovereign risk, which is also a major form of credit risk. Then the third dimension which I should see with respect to credit risk is the credit derivative products. See, the most common example being, let's say here, credit default swap. As we all know, the working style of a credit default swap, I would just like to quickly look at it. Let's say A has borrowed something from B. So there is an obligation for A to pay B, let's say the interest at some regular intervals and principal at the end of some period. Now, B is exposed more to a credit risk because this A can default on its payments. So B is exposed to a credit risk there. So what B can take is, it can try taking a protection from C by paying some premium to it. Now, what is this protection? If A defaults, C will be compensating B accordingly. That is what is the background behind the credit derivatives, or credit default swap, the more common form of credit derivatives. We have so many other forms of credit derivatives also, but here what we are simply saying is B will keep paying premium, let's say every year on an annual or semi-annual kind of a basis to C, and C's job is only when A has defaulted either on the interest or on the principal portion, that portion, or depending on the agreement, the entire amount, whatever it is, that would be compensated by C to B, which means B is protected from A getting defaulting, but B is incurring a slightly extra cost in the form of a premium. Now, here probably the C, which is acting in the role of taking the risk of A to make B, to lessen the risk of B. This is where we are looking at risk transfer kind of securities. So in case of the risk transfer kind of securities, again, one party could still be at a risk depending on the credit quality associated with the underlying borrower. So that is one more area which we have to look at when we talk about a credit risk. And the final dimension that I am looking at is the structured products. We have seen today there are so many structured products that are coming up in the market, called, let's say, collateralized mortgage obligations, collateralized debt obligations, collateralized loan obligations, something on the lines of mortgage-backed securities, a structured form of asset-backed security. So, what are these structured products? It's a pool of mortgages, pool of loans, pool of bonds. They are packaged together and sold to a third party, and based on them, the pool of loans packaged sold to a third party, against which this third party is issuing the bonds in the secondary market. So these are the bonds that are issued. Now, generally, this third party, which has created the financial instruments out of the pool of loans, which has created those structured products, it is perceived to be default free. But what could very well happen is, if the number of defaults on this underlying mortgage is increasing drastically, then probably the value of these bonds is going to go down drastically, and there is going to be a write-off from the creditor's perspective. Even that is what we are talking about, an exposure to credit risk itself. So that is where we will be seeing credit risk can arise from a multiple dimensions, right from the basic corporate loans and bonds, where we could see some kind of defaults or delay in the payments occurring, to the extent of credit derivatives and structured products, where you could see credit risk present to a great extent, right? So which means our primary intention is to value the various credit risky securities. How do I value the credit risky securities? And how do I take the mitigation mechanisms for the same? Now, from that dimension, first thing I would like to understand is the difference between the book value and the market value of a security, of any security. When I have to talk about the book value, it is purely the accounting based stuff. It has nothing to do with the market. Whereas the value, when we are talking about as a market value, the values are purely taken from the market, which means they are updated at regular intervals of time. Whereas these numbers generally they are historical. At the time when we have taken the loan, whatever is the amount we have taken, that is the value that we are representing. But that particular loan value today, if it has either gone up or gone down, that particular numbers are what are shown as a part of the market value. So generally this is one major difference. So when we are talking about this kind of a balance sheet, we call it as accounting balance sheet, whereas when we are preparing a balance sheet using this mechanism, we call it as economic balance sheet. So the assets, though in both of them the assets should be equal to liabilities plus owner's equity. Here the assets, we generally represent them as the liabilities plus owner's equity at that particular point of time t, which means the values are updated on a regular basis. Right? So from here on a regular basis we can try computing either the equity ratio, which is nothing but what portion of the total assets is the form in the form of equity, or sometimes people take it the inverse of the same, call it as leverage ratio. To what extent the firm is levered, total assets divided by total equity. The higher it is means the higher is the composition of debt and vice versa. So, from the purpose of valuation, it's always important for us to understand the market value dimension or a fair value dimension rather than looking at the bookish value. Now, but we all understand, I think, the differences between the equity and the debt. What we generally see is the debt investors will start losing, will start facing a loss after all the loss is absorbed by the equity investors. So, after the equity investors absorb all the loss that they kept to the extent of their investment, after they absorb all the losses, so only after that the loss starts happening to the debt investors. That is the typical structure of risk taking in any capital structure. So the higher is the composition of the equity, a very rare chance that the debt investors will face any kind of a loss. But if the composition of the equity is much lesser, then the chances of loss for a debt investor are going to be much higher. So without getting too much into the debt and the equity portions, under the assumption that we are all comfortable with what goes into debt and what goes into equity, and how the equity investors are compensated, let's say in the form of dividends, whereas the debt investors will get a fixed amounts in the form of interest or coupons. So the risk associated with equity investment is much more higher compared to the debt investment. So the compensation wise also on an expected basis, the equity investor will receive more compared to a debt investor. All right. Now we will look at the various debt seniorities. Though we know that the debt as a capital, the failure to meet those obligations is a part of the credit risk. So we are trying to see what kind of securities fall typically that are issued by the companies that get into each of these categories. So we talk about a seniority in the debt. See, when we talk about the seniority, some particular bonds and loans have high priority over the other. Means in case of default, these bonds and loans should be settled first compared to the other bonds. So the rights and especially the timing of the payment, the priority and the amounts of cash flows, there are differences among the different kinds of bonds that are issued. It's not the case that all debt will have the same kind of settlement. See, in the earlier slide, I was talking about the equity will start getting that the equity will after the equity has absorbed all the losses for the debt investors will start flowing in. On the other way, I could put that statement as, first, in case of a liquidation of a company, it's the debt holders who are paid first, and the equity investors are being paid after all the debt investors are being compensated. Now, among those debt investors itself, do I have a uniformity across all of them, across all the various debt products, or is there any kind of a differentiation in terms of the settlement for the different debt products? And that is what I am trying to bring in from the dimension of a seniority. So when I say high senior debt, so that is going to get the cash flows at the first priority compared to the other kind of bonds and debt instruments. So whenever we are talking about a seniority, it is more in terms of the repayment priority. So logically, we are talking of the debt in the debt also. We may talk about the senior debt instruments receiving more priority in settlement. Then probably then we are talking about a middle level debt, and finally it is a junior or a subordinated kind of a debt. So within these debt instruments also there is a kind of a classification, and depending on a particular instrument where it is getting categorized, the risk associated with that instrument gets determined. Now, apart from this dimension, I also see that there are some debt instruments, right? Some debt instruments which have the characteristics of both debt and equity. They are issued currently as debt instruments, but they have the characteristics of both debt and equity. So let's say like a preferred share, preferred stock, or probably I would talk about a convertible bond, and I can also talk about PIK bonds, payment in kind bonds. Now what we could see as preferred stock, it is a mix of debt and equity. Why so? It pays a fixed amount of dividend every year, just like a debt. fixed dividend every year, no voting rights. So some characteristics of debt existing in this kind of an instrument, whereas it is also having no maturity date, which is a characteristic of equity investments, and no legal obligation to pay dividend. Though it's a fixed dividend, only when a company has generated a profit, they will pay a dividend, but it's not a legal obligation. But the only obligation is before paying to common equity, right? Before paying to common equity, the payment to preferred stock should happen. That's the only thing that comes up. So which means on a yearly basis, regular basis, it's not mandatory that the preference shareholders need to be paid the dividend. So it has some properties which are purely debt related characteristics, whereas some of them which are purely equity related. So that is from that dimension we treat a preferred stock as a combination of debt as well as equity. So even from a settlement perspective also, we talk about the priority being somewhere in the middle of debt and equity. So within the debt, we talk about the senior debt, subordinated, and the final sub-junior kind of a debt. So after the settlements happen to all those instruments, we talk about the preference shares, and finally it goes to the common equity investors. The other kind of instruments which can be classified as a mix of debt and equity are convertible bonds. As a part of the convertible bond, initially the company would have issued the bonds itself, which are pure debt instruments, but they have a conversion feature saying, okay, at a specified future date, each bond can be converted into some X number of shares of the company. But that is not now. That is after a future date. After a future date, each bond can be converted into some X number of shares of the issuing company. So probably from an options dimension, I could have written it as a non-convertible plain bond, non-convertible bond plus a call option given to the investor. If he wants to convert it into equity, he can convert it, or he can continue with the bond part of it itself. But in some cases we see it's a mandatorily convertible kind of a bond. So because they are providing some equity kind of features etc. in this, it is again having a priority somewhere in between the debt and the equity instruments itself. And the risk wise, this risk is slightly more than a traditional debt, and it is slightly lesser than a traditional equity instrument. So that is where the risk as well as the settlement thing lies between the debt and the equity instruments. Then similarly, a third kind of instrument that comes in this category is the PIK bond, payment in kind. Here, the regular interest payments do not happen, rather they increase the par value. So probably it's like the interest that has to be paid at regular intervals, that is getting accumulated and increasing the par value. That is why we call it as a payment in kind of a bond, because it is resulting in an increase to the par value rather than any kind of a cash flow happening, which means the company which has issued this PIK bonds, it is trying to defer the coupon payment. right? So it is trying to defer it as heavily as possible, as to a larger time period as possible. This generally happens when the firm has got into a leverage buyout mechanism, raised a loan to buy out the equity stake of a company. That is what we call as leverage buyout. So that company which has been bought out, it has to be restructured, and a lot of workout has to happen on that particular company before it can generate the profits. Initially, they don't want to incur this interest and all and create negative profits and negative cash flows for the company. So this is where they can get into this PIK form of bond, where the interest or coupon payment is getting deferred and getting accumulated and increasing the par value of the bond. So all these kinds of instruments, they are having risk which is in between that of debt and equity. So their settlement wise also, they will get settled in terms of somewhere in between the debt and the equity investors itself. So this is one dimension with respect to seniority, where in general the seniority is debt, probably a composition of debt and equity instruments, and finally equity. So pure debt instruments will have a high priority, whereas the debt and equity blended instruments will be next in line, and finally the equity investments will get, in case of any kind of default or in case of any kind of liquidation of the underlying firm. Now within the debt itself, we have two more classifications. Within the debt itself, we use the words secured, unsecured. We have used senior, subordinated as one dimension. Secured versus unsecured is what I take as another dimension. Now, when I am talking about unsecured, we are talking about a general claim. Means, in case a default occurs, whatever are the assets that are there with the company, we can sell off those assets and we can get our settlement. These guys can sell off those assets and get their settlement. But when we talk about a secured loan, the lender will have a collateral. The lender will have a collateral exclusively defined for that particular borrowing, and in case of a default, a specific access to that collateral can be done. So this collateral typically is like a lien. It cannot be assigned to multiple lenders. So this is a collateral which is a lien, and in case the borrower defaults, the lender can then capitalize on this lien, convert it into a cash, use this lien for all the proceeds, and whatever the balance cash that comes up, probably let's say the secured loan is to the extent of 1 million, but the collateral is taken for 1.5 million. So in case the default occurs, this collateral can be sold off and 1.5 million is generated, 1 million is taken by the lender and the remaining 0.5 is returned back to the owner. Whereas in the unsecured claim, when we talk about an unsecured lending, probably that this particular lender will not have access to this collateral at all, because it is something that is assigned to a secured lender. So whatever are the assets that are left without getting assigned to any of the secured lending, a claim is available on those assets in general. Whatever are left off, the claim is possible on those assets itself. So again, so order wise, if you see, the secured ones are getting more and more priority in the claim because they have a specific asset against which they can claim, whereas the unsecured lenders are getting still the residuals itself. And in a typical loans, especially the secured form of loans, we see a few more important terms. We have to understand a few more important terms. People talk about a term called haircut. Very straightforward. Let's say if the borrowing is for 1 million, right? They may want a collateral which is at least 1.1 million, which means they are trying to put a cut on the value of the collateral. They are trying to put a cut on the value of the collateral and lend only that much amount, which means they are making sure that at any point in time the collateral value, they want to ensure, the lender wants to ensure that the collateral value at any point in time in future also will be greater than the loan amount. So they will try to put a cut on the value of the collateral and lend only that part of the amount. So when they are looking at 1.1 worth collateral, they are lending only for 1 million, which means around 10% they have put as the haircut. Means they have reduced the value of the collateral, let's say by 10% to make sure that whatever they are lending is not the full amount, and even if the collateral falls in value by another 10%, they are not going to lose off on their loan that they have given. So, and this collateral value keeps changing at regular intervals of time. So that is where we are talking about a variation margin. If at all any changes in the haircuts are happening at regular intervals of time, we are calling it as a variation margin, but generally we are talking about an initial haircut where the loan amount will be to a some percentage lesser than the amount of the collateral. That is one thing we have to understand in case of a secured lending process. Then the other term that we need to understand in this process is the recourse. The lender, does he have any kind of access to the borrower's personal property? Access to a borrower's personal properties in case the collateral is insufficient. Right, when we are talking about a recourse, this is a recourse loan. When I say this particular loan is a recourse loan, the lender can get an access on the borrower's property or assets if the collateral is insufficient for the entire loan payment. Whereas when we talk about a non-recourse kind of a loan, this access is not there. Whatever is the collateral that is coming up, the settlement has to happen from that collateral itself. Even if the collateral is value of the collateral goes down also, there is nothing much the lender can do. He has to accept that kind of a loss itself. So the lender does not have any claim beyond the collateral. But if we talk about a recourse loan, yes, the lender can access the borrower's assets also, can have a claim on the borrower's personal assets also if it is found that the collateral is insufficient. So whenever, and the third dimension obviously I have talked about is in terms of the priority associated with the settlement. So generally we see all secured loans will have a high priority compared to unsecured, and even within each of the unsecured, probably senior will have more priority compared to junior. So this is how the priorities in terms of settlements happen. Right, so a good understanding on the various credit risk oriented products, especially all these are associated with the corporate debt, corporate bonds and corporate loans issued by the corporate. They can get into any of these various instruments. So understanding where they stand in terms of seniority, in terms of the settlement priorities, which will give us assess the credit risk associated with these kind of various financial instruments quite comfortably. All right. Now, the other dimension that we should look out with respect to this credit risk is in normal credit transactions, we see that there are some kind of frictions that can come up. Means conflict of interest, some kind of difference of opinions, difference of priorities. They can very well crop up. Sometimes what we see is information wise, the borrower is expected to have more information than the lender. Borrower knows for what purpose he is putting that borrowed money, right? How he is going to benefit out of that particular transaction. So it is always believed that the borrower will have more information compared to a lender, and so it is very much possible that the borrower, because he is the person who is having the liability to pay, the lender is exposed to risk, whereas the borrower is having a liability or an obligation to pay to the lender. So it's very much possible that borrower can try to understand some information and probably try to default. So because of that, what the lender may have to do is he has to get into a constant monitoring process of the borrower, and at the same time take as many disclosures and take as many documents or collaterals and all those things from the borrower to ensure that the excess information which the borrower has, which can help him to default, he will not default because there is something more which is taken either as a collateral or a protection from the borrower. The second dimension that comes up, just like any other investment case, is your principal agent problem. I hire an agent to perform my duties, and the agent is always in the process of trying to maximize his own benefits rather than the benefits of the organization. So especially in the investment space, I hire the agent to typically do the investment management or increase my worth. He tries to get into those kind of transactions which will increase his own worth and value rather than adding value to the firm. That's a very common scenario. And we also see a risk shifting as a very constant friction that can come up, especially between the equity and the debt investors. See, typically when we talk about a debt investment, a borrower or a lender, now he always wants the dividend payments to the equity investors should be much lesser, because otherwise the company's payment potential towards the debt investors will go down. If it is paying more and more of equity, its growth opportunities are going down, and because of that, there is a risk that the bondholders may not receive their interest commonly in the future. On the other side, the equity investors think it would be better that if the firm increases their risk because their equity returns are going to increase. So if they increase their debt, if the firm increases its debt, probably they can get a much higher return on their equity, but their risk is limited only to the extent of their capital which they have invested. So the risk is shifting from the equity investors to the debt investors. So this is, in some cases, what could happen is the risk can shift from the debt to the equity investors also. And so typically when we are talking about too big to fail kind of companies, the loss, so they are borrowing heavily. And what could very much happen is because of the loss, because of an inability to pay back their borrowed amount, it's so happening that their value is falling quite drastically, and within no time the equity investors are losing the full of their amounts. So the risk is shifting from the debt holders to the equity investors, whereas in some cases it is shifting from the equity investors to the debt investors itself. Similarly, we have the problems associated with moral hazards, which is another problem more and more specific to an insurance industry or probably any kind of lending borrowing scenarios. See, for example, I have taken an insurance protection. Right, the insurance is primarily targeted towards compensating in case a loss has occurred. But sometimes what could happen is, just because I have taken the insurance, I would not take the minimum care to protect myself, saying that I have insurance. Probably let's like I have taken a home insurance policy. I have insured my home against let's say the theft and various other risks. Now just because I have insurance, I may think of not even locking my home. When I am going out, I am not even thinking of locking my home because I have taken an insurance which will compensate me in case a theft has occurred. So these kind of scenarios are associated with moral hazards. All these things can create some kind of problems with respect to the credit contracts, whatever is the credit related contracts that we are getting in. All these could create problems. Even there could be a problem with adverse selection. Probably a person buying a particular product will have a different opinion about the product, and the person who is selling the product will have a different opinion. They try to hide the information, the seller tries to hide the information from the buyer and tries to sell the product, which could result in even a non this could result in an asymmetry which could lead to a credit risk even at a later point in time. So there are various instances that could create frictions in the credit markets. We need to understand all those dimensions also. Now let's try to understand the dimension of the default. See, when we talk about default, we talk about a distressed exchange, as well as an impairment. Impairment is more like the value of the assets or securities going down and the loss being written off. Whereas a distressed exchange is basically a new set of securities at lower value, having a lower value compared to the original set. So all these are typically getting into the default, or in short, if I want to understand default, it is nothing but the value of the firm, value of the assets of the firm are less than the value of the debt, value of the liabilities. Liabilities or debt. If the firm value is less than the value of the liabilities, that is where we are talking about the default. Means whenever the value of the equity of the firm is either zero or negative, that is what is an indication of default. But even without a default, we can talk about the impairment, the value of the assets going down, the value of the assets getting written off. Because if whenever we are seeing that a particular firm cannot meet its liabilities, is not able to meet its liabilities, it can be forced into a bankruptcy situation. So it is forced into a bank whenever the assets are not sufficient to meet the liabilities. It is being forced into a bankruptcy position, wherein the protection coming from the lenders. Whenever we talk about a bankruptcy, we are talking about going for a protection from its lenders. So there could be terms regarding, there could be some kind of negotiations regarding the reorganization of the debt or restructuring of the debt. Probably increasing the term of payment, duration of payment, or talking about converting a debt into equity. So either there could be a reorganization or restructuring of the debt. So that could very well happen in case of any kind of an impairment. Now for us, even this comes under the default, and even the whole bankruptcy or value of the firm going much lesser than the value of the liabilities, whatever may be the case, even if it is a distressed exchange or an impairment, that is what is coming into the scope of default. So in case of every firm, a few terms that needs to be comfortable with respect to the understanding of the credit is: one, the probability of default. What is the chance that this particular firm will default, that this particular borrower will default in a specific period of time t? So this is always the probability of default is associated with a specific time horizon itself. From now, so either it could be looked at as from now up to time period t, what is the chance of default, or probably from let's say after t period to t plus 1, between t and t plus 1 years, what is the chance of getting default. So whatever we are defining, there should be a clarity in the definition process, because probability of default is more associated with the chance of not being able to pay, or chance of getting into either a distressed exchange or an impairment, which is chance of defaulting within a specific time period. So it could be either from now to a particular period, or between two dates in future itself. So we need to understand the probability of default. Then on the same lines, the other term that we need to be comfortable with is the exposure at default. When we say exposure at default, it is purely the amount. It's purely the amount that can be lost in case a default occurs. So for different kinds of, see, in case of a loan amount, whatever is the amount that is still outstanding to be collected, that is what will be the exposure that is at default. But in case of derivative contracts, it is purely dependent either on the NPV, right, or probably even finding out the value of the position, which is nothing but again the NPV, the value of the position at that particular point in time. That is what will be taken as the exposure at default. Then one more term that gets into this understanding process is the loss given default, LGD, or on the same lines we even use a word called recovery rate. Both go hand in hand. See, in case the loss occurs, in case the default occurs, what is the proportion of the lent amount that is lost by the lender? Because if there is, let's say, a collateral, or even if it is an unsecured loan, there is some kind of access to the assets of the company. So which means there is some amount of recovery that is happening. It's not the 100% of the lent amount that would be lost. So it could be somewhere between 0 to 100%. So that particular percentage is the amount of loss that can occur, the proportion of the borrowed money or the lent money that would be a loss to the lender in case the borrower default. That is what we are calling as the loss given default, which means these two are connected like this. If I say loss given default is 20%, I can say that the recovery rate is 80%. So these are binded by that kind of a relationship. Recovery rate will come out as 1 minus the loss given default percentage itself. Right? So whenever we are talking about the recovery, whatever, see, probably in case of a secured loan, the recovery could be much higher, whereas in case of unsecured kind of loans, the recovery rates could be much lesser. If the recovery rate is lesser, the loss given default will increase and vice versa. But at the same time, what we could see is there could be a strong correlation between the probability of default and loss given default, because in general also, if the probability of default is very high, it means that the chances that this party will default is going to be very high. What we could see is those kind of firms, they tend to borrow more also, which means the loss given default also is expected to be much higher. So that's where modeling this kind of scenario becomes much difficult. Had these two things being completely independent, the modeling would have been more and more easier. But it is observed that as the probability of default is increasing, the loss given default also is expected to increase, which is what could create a complication in terms of the modeling aspect for the credit risk itself. So, but in general, what we see is in most of the applications, they set some target values for this loss given default and try to treat it as a constant itself. So that way the modeling process becomes more and more simpler. Whereas in real world there could be a lot of interaction that can, a lot of correlation that could exist between the probability of default and the loss given default. Right? So from these three elements, we will try to compute what we call as the expected loss. This is an important component in case of credit risk. The expected loss is nothing but the multiplication of all these three elements. The probability of default multiplied by loss given default multiplied by exposure at default. This is an expected loss and this expected loss should be mentioned in the income statement. This expected loss should be mentioned in the income statement as an expense item. It's a provision. So it's an expense item that needs to be shown as a provision, which is an expense item into the income statement. So this expected loss is purely when we are talking about probability of default, loss given default, and exposure at default, the multiplication of them is the expected loss. And in case we are trying to get different expected losses, for example, let's say I am having a probability of a credit rating change multiplied by the change in value because of credit ratings. So if I have one more loss element that is coming up apart from the default, I will be taking the weighted average of all those things and finally trying to compute my expected loss. So based on default, migration, any other instruments that are coming up, whatever is the expected loss that is computed. Now, the biggest argument that comes up is if it is known that there is a loss, I mean there is some scope for default and not 100% can be recovered in case of a default. If it is known, why is a lender getting into the lending process itself? Why is the bank giving a loan itself? Why lend? Now that is where we are trying to go with an equation saying the lender will keep lending if he is compensated with a higher return. So normally compensation by some X percentage more than a risk-free rate of return. So let's assume that I am lending some P amount. Right? I am lending some P amount. If I am talking about, let's say the P is what I am investing in a risk-free security. At the end of, let's say 1 year, I am going to get P into 1 plus R as the amount on that investment, where R is the risk-free rate of return. But now consider a separate scenario, okay, out of this P, I have lent it. Now when I am lending it, there is some possibility that this person will default. There is some probability that the person will not default. So in case he is defaulting, what is the amount I can get? I can get the recovery rate times the amount P, right? Whatever is the P, in case he is defaulting, I'll get the recovery rate percentage of that. And the chance of I getting that is nothing but the probability of default. Whereas in case he is not defaulting, which means 1 minus PD is the probability that he is not going to default. And in case he is not going to default, I'll get, let's say, 1 plus R plus X. Now, as long as this number, probably if I take out the P, I can write it as 1 minus probability of default multiplied by 1 plus R plus X plus probability of default multiplied by the recovery rate. As long as this is greater than 1 plus risk-free rate of return, the investor will prefer taking the risk as long as he is compensated with this excess return, which in this equation will lead to a value for the left hand side to be greater than the right hand side. So as long as that excess compensation is to that extent, the investor is willing to take a risk. So that is where we see that whenever a risky investment is coming up, the investor is more interested in seeing that the expected rate of return on the risky investment should be greater than the expected rate of return on a non-risky kind of an investment, right? So this is one more dimension apart from the calculation of the expected loss and all. Why should a lender get into a lending process in case he knows that there is some possibility that he is not going to get his amount back, right? Now the other dimension, which is a very important dimension for us, is understanding what is the thin line of difference between a credit event and a market risk event, right? Because there is a lot of interlinkage that is existing between these two. When should I treat something as a part of a credit risk? When should I treat something as a part of the market risk? So especially anything to do with the price movements, right? The loss that is coming because of the price changes. It could be because it could be the price change for a credit security also, but anything which is resulting in the change in the price, that is purely associated to market risk. But anything that is to do with default on the obligation or not honoring the obligation, whatever is the obligation that the borrower has to pay something to the lender at this particular date, this particular amount, that is a contractual obligation. So in case the adherence to that obligation is not happening, or some kind of downgrade, credit downgrade of a particular security is happening, then they get treated as a part of the credit risk events. Now, so which means there is a possibility if the value of a particular security goes down or a value of a particular instrument goes down, then I should look at it as a market event. But or probably if the interest rates are changing, the value is going down without any kind of a default or a downgrade coming up, any kind of a loss that is occurring, I should look at it as a market risk itself, because in general this is a very thin line of difference that is existing between the two. But on a general scale, for you to understand any kind of loss that is occurring because of price changes, interest rate changes, that is getting associated as a part of the credit market risk, whereas anything to do with the defaults and the credit downgrading that is happening, right? All these things are getting as a part of the credit risk events. So even sometimes the perceived credit quality also could give rise to a credit risk event, which is typically getting classified as mark to market kind of a risk. Wherever mark to market kind of a risk, so even if the credit migration at this moment did not happen, but if it is perceived that in future the credit quality is going to become very bad, we are looking at the spread increasing, because we are perceiving that in future the company's credit position is going to go bad. So whatever is resulting in the increase in the spread because of the perceived credit quality in future, this is also a part of the credit risk, which is called as the mark to market kind of a risk. So a better understanding between the various credit risks as well, what gets the differentiation between the credit risk and the market risk is very much essential for us, right? Now The next thing which we will be looking at is the various techniques that are used to assess or to compute. Probably let me use assess because there are some qualitative stuff also. So to assess the credit risk, what are the various techniques that are available? The more common of those techniques is the credit ratings, generally given by external agencies, let's say like S&P or Moody's or Fitch, more common rating agencies. So these agencies, they provide the ratings to each and every issue. So it may go probably a AAA rating means the defaults are very less, very little chance of default. So they may go from AAA to AA to A to triple B to double B like this, and so on. It may reach the letter D. The D is like a default category, right? So each one has a different way of representing the same. The AAA S&P might represent it in some form, and with a minor difference the Moody's can go with, but the end intention is anything to do with the letter A is of a higher rating compared to a B, more A's, more higher rating compared to more B's. So the order flows in that kind of a format. So for every issue, for every company, this kind of a credit rating is being provided. And along with this credit rating, there is also a rating migration matrix, or probably we'll call it as ratings transition matrix, which is like, okay, at the beginning of the year, these are let's say these are the ratings, and at the end of the year, these are the ratings. Now what is being mentioned is, let's say this I call as AAA, AA. Probably this I call as or double C or C. Here also I'll put AAA, AA, and probably let's say I'll go up to default here. What is how many firms which were having AAA rating at the beginning of the year ended up on AAA rating at the end of the year, let's say 90%. How many of them, how many of them which are AAA at the beginning of the year became AA at the end of the year? 5%. So like that, at a matrix of this form, how many of the AAA firms defaulted? Let's say 0.2%. Now what we are saying is, this kind of a matrix is called as the rating transition matrix, and this is typically prepared for a 1 year period. Means within 1 year, what is the chance that a firm will move from a AAA rating to a AA rating, or move from AAA rating to default, move from triple B rating to a AAA rate, all kinds of transitions from all states to all other states. The probabilities are being mentioned as a part of the transition matrix. And you see here on the left hand side, we don't see a default. In this rows, we don't see a default. I haven't represented. I have gone only up to a double C or a C here, whereas this side I am going to a D, because here the default state is from default I cannot go anywhere else. So default state is actually called as a terminal state, wherein I can only enter into that state but I cannot move away from that state. So we have even that kind of thing that is associated, which we have to represent as a part of our transition matrix. So this side I should not show the D, whereas this side I needs to have the D. And what is generally observed is, across this diagonal we see that the numbers are much higher, which means the probability that a particular company which was with a particular rating at the beginning of the period, it will continue with the same rating at the end of the period. That proportion of companies are much higher. But at the same time, what we could see is somewhere here on this diagonal towards this lower end, we'll see that these percentages are much lesser also. Means there is a high chance for these kind of companies, let's say they can jump into default quite easily compared to this company. So that is where what you could see is continuing in the same rating will be not that easily possible for the companies which are at the lower end of the diagonal compared to the higher end of the diagonal. That's one more thing that we need to understand. But in all this, see the ratings generally which are done by the external rating agencies, companies are the bond issuers. The bond issuers, they pay to get themselves rated. Now this is what will create a conflict of interest. Right? They are paying the rating agencies to rate themselves. So there might be very much possible that these rating agencies compromise with these bond issuers and try to provide a better rating or a higher rating to these bonds, which could impact which could create huge losses for the investors, because they have invested in that security under the assumption that the risk is much lesser with them because they have a much better rating. So this is creating a conflict of interest. So that is where what you could see is the many companies, apart from relying on these external credit rating agencies, they have their own internal models. They build their own internal models and try to communicate the same with their investors. So this internal models today, they are classified. We talk about the credit models which can be built internally. They can be classified as the reduced form models or a structural model. Structural models are very important. We'll discuss some of them later on. The structural models, they help in estimating the credit risk. Probably they help in estimating the probability of default and all that stuff, which can even help you in estimating what is the expected loss in case a default is going to occur. What is the expected loss on this particular set of securities? Whereas when we talk about the reduced form models, they don't estimate the probability of default, loss given default, etc. But they simulate the default times. We'll take a couple of examples of the same. They simulate the default time to default. So what we are trying to say is organizations get into the process of building their own credit risk models, because the rating agencies' credit ratings, the credibility associated with them will get hampered because of the payment that is happening. But on the other side, there is an argument which says the credit rating agencies, if they try to offer higher ratings to companies by taking higher amounts, their reputation is at stake, because the major thing for a credit rating agency is the reputation. Right? The more they are able to objectively assess the performance of a particular issue and give an appropriate rating. So they are actually selling their reputation. So if in a good number of cases, whatever the companies which they have given a higher rating, they actually default, it could result in a big impact on the reputation of the rating agency, which could question their basic existence itself. So from that dimension, there is a school of thought which says rating agencies, though they are paid, they cannot be very heavily biased in their rating because their reputation is at stake, and that reputation is the sole business which they are typically getting into, sole criteria behind their business success. So even if they get paid, they may not look at providing unrealistic ratings to these companies. But at the same time, the companies are the issuers are also getting into their various internal credit risk computation models, which can help them to better assess their credit risk and take necessary actions accordingly. Right? Now, the next important risk that we are looking at in this context is a counterparty risk. This is also a special form of credit risk wherein we don't look at a traditional loan or a bond, right? We don't look at a traditional loan or a bond here. It is more at the transaction layer. And in this transaction, probably there is a risk to both the parties. So the parties which are entering into this transaction, there is a risk that one will not adhere to the contract, whereas the other one has fulfilled the contract. So whenever such a kind of transactions occur, whenever such a kind of risk occurs with respect to a single transaction, one party not adhering to the other party. So there is nothing called a lender and a borrower here. It's a two-way transaction. So one party gives something to the other party and takes something else from the other party. So in this kind of a transaction, when one party has fulfilled whereas the other party has not fulfilled the obligation, we are saying the party who has fulfilled the obligation is exposed more to this counterparty risk. So we don't talk about the words the lender and the borrower here. Generally, it occurs in two major kinds of transactions. One is the over-the-counter derivatives transactions. In over-the-counter derivatives, probably it could be the forwards or swap kind of contracts, where one party is paying something. Let's say when we talk about a swap, one party may pay a fixed rate and receive a floating rate on a particular instrument. Now it can so happen at any point in time in future, either this party may fail to adhere to the contract or this party may fail to adhere to the contract. And in general, let's say when the value is positive for this party, we see that the chances of this party defaulting are higher. Similarly, when the value is positive for a fixed rate payer, we see that the floating rate payer might default in that process. So the value of the investment is still positive, but still one party may try to not adhere to the contract to the other party. That is what is an important thing that comes up as a part of counterparty risk. Probably the big difference that you can see between a market risk and a counterparty risk is, in a market risk, I see that the value of my portfolio becomes negative because of change in prices or interest rates and all. The value of my portfolio might become negative. The value of my investment might become negative, and that is what I am calling as the market risk. But In a counterparty risk, the value of my investment, the NPV of my investment is actually positive. But here, when it is more and more positive, I expect my counterparty not to adhere to this transaction. So that is what I am trying to classify it as a counterparty risk. And in general, in a counterparty risk, both the parties will have a good chance of this counterparty risk existing, because any of the parties can default at any point of time. So that is where, rather than having an OTC derivatives, probably the exchange traded derivatives market like futures and all, where the exchange is intervening in the process, the chances of reducing the counterparty risk increases, especially in exchange traded derivatives contracts. The counterparty risk is reduced drastically, because the exchange or the clearing house acts as a counterparty to the other side of the transaction. So we see counterparty risk very heavily in the OTC derivatives contracts and typically in the brokerage relationships, especially when we talk about, okay, client depositing a money with a broker margin, right? Client with the broker, let's say some kind of margin deposit is being done for his transactions. Now, to a large extent, it is understood, probably it has been the story, that broker is more exposed to counterparty risk, because it may so happen that the client may fail to pay to the broker. But the recent financial crisis has shown that there are instances where broker was not able to pay to the client because of the margins and all. I mean, whatever the margins that they have taken and the decline in the value of the position, the broker was not able to pay back to the client. What was a specific case of even the Lehman Brothers also. So what we could see is even this turns out to be a bilateral kind of a transaction, right? So even from that dimension, a counterparty risk can arise. So the most common forms of counterparty risk that we observe are in the OTC derivatives, where again there is a bilateral transaction, and similarly in the brokerage kind of relationships also. Now, what are the ways that are available to reduce this counterparty risk? A very common mechanism people talk of is the netting process. Now, there could be a lot of contracts between A and B, between two different parties. There could be a lot of contracts on lot of terms and conditions and different quantities at different points in time. So there could be multiple such kind of contracts. Now what we are saying is, whatever the payment that one party has to make to the other, we can net it off across all transactions put together. If we net it and make it as one single, probably a firm, so we can make it as one single transaction which is netted out of all these things, a one single payment from A to B or B to A, whatever is the difference that is existing. So that way the net amount will become a very small quantity, which means the exposure is coming out much lesser to either of the parties, rather than saying each contract is treated separately, wherein each transaction will have a different exposure to risk. So by doing the netting, we are benefiting both the parties, because overall we are reducing the exposure that is to risk to any one of the parties. So that way the overall counterparty risk is reduced. But the same thing can be extended to a situation of multilateral netting, wherein we are even trying to bring out the multiple counterparties. Probably there are some with respect to C. The overall netting with multiple counterparties is what is coming out as the multilateral netting agreement. But here the problem becomes more and more tougher because computing the exposures is very much difficult. But still, it would reduce my overall counterparty risk the moment I am getting into any kind of a netting process. And that is one of the prime way you could look out, because if there are multiple counterparties dealing with one single counterparty, which is like this becomes a centralized kind of a counterparty for various transactions, and that is what is a concept that has given rise to clearing houses and exchange based transactions, because it looks like a multilateral netting kind of a situation itself, right? Now, the other way I could look at is using the margin as a concept. Each party deposits a specific amount with the other party. There could be a initial margin where both the parties will deposit something with the other party to mitigate themselves against the counterparty risk. And as and when the time moves, as the value changes, the margin that needs to be deposited can either go up or go down, which is typically called as your variation margin. So we are trying to either increase the margin position or decrease the margin position. Yeah, in some cases this value will be much lesser, whereas this could keep increasing, whereas in some kind of transactions this itself could be much higher. So what we are typically talking of is, once a margin is there, if one of the parties is defaulting or not fulfilling the obligation, the other party can very well use the proceeds out of the margin. But here the problem comes. So the margin which has been taken by the counterparty, after adjusting for the expenses, it has to be, the remaining has to go back again to the party. But if that is not getting settled, that is where the broker relationship is getting very badly impacted. Right? So margin and marking to the market for those margins is another way that you can reduce your counterparty risk. So in general, when we have to address our counterparty risk, we see that the exposures, whatever are the various exposures to each of the counterparties, they need to be measured accurately. Most important thing. Undervaluation or overvaluation will result in increasing my risk, and keep looking at the financial stability and condition of the counterparty at every stage on a regular basis. Keep monitoring the financial stability of the counterparty, his ability to pay or to adhere to the obligation, and if possible diversify, use multiple counterparties. So even if you are losing on some of them, you would gain from the other, and overall it gets neutralized out. And if at all you are seeing that any counterparty becomes more and more weaker, try reducing the exposure to that particular counterparty. Try reducing your exposure to that counterparty, and try exiting out of the positions with respect to counterparty. Means you reduce the volume transactions, or so I can reduce the exposure by reducing my volume, number of transactions I do with that counterparty, or I could demand more and more collateral requirements from that particular counterparty. So all these things can very well be done to try to address this counterparty risk. But a few more interesting aspects that come here on the lines of counterparty risk, probably it's worth for us to understand what we mean by a double default risk, which is a very interesting extension to your counterparty risk, wherein, let's say, in a typical CDS, you see this scenario. Okay, A has borrowed something from B. So B is exposed to credit risk from A, protecting itself by getting into a CDS credit default swap with C by paying some amount of a premium. Now, if it so happens, okay, the A defaults and at the same time C also defaults. This generally is assumed to be a default free kind of an entity, but because of correlations breaking down quite drastically, it might so happen that A is defaulting and at the same time C is also defaulting. This kind of risk is what we are calling as a double default risk. This is something which has happened with the case of AIG, which has written so many credit default swaps on the default of the counterparties. Right, on various credit exposures, it has written so many credit default swaps and it was not able to meet the obligations. So, which means while the original borrowers have defaulted, you also see that this CDS companies also have defaulted, which has resulted in a huge losses to this particular parties, which have got more and more exposed to a double default kind of a risk. So this is one major risk that we need to understand in context of the counterparty risk. Apart from that, we should also look out for custodial risk, especially when there is a custodian involved and the default is happening from the custodian, because the custodian's job is basically collecting all the cash flows like the dividends, interest that are received, that are issued by the issuers. The custodian's job is to collect all these things and transferring the securities, collecting the money, selling, lending, transferring the securities to be available for the delivery. So here, if at all the custodian is defaulting on any of these things, especially in case of margins, even the margins also, maintaining the margins and all, the custodian is responsible for the same. Now, when we are depositing something as a margin, it will not be in the name of the customer. It will be in the street name, which is like a broker's name. So what could very well happen is, if at all some kind of credit loss is going to occur, the custodian can easily withdraw the money from this particular account and transfer it to the lender who is who is facing credit losses. So if it is in the customer's name, probably this cannot happen, but because it is in the street's name, the custodian can very well withdraw the money and transfer it to some other account. Now this is where the custodial risk comes up. If the default is occurring from the custodian's dimension, in either transferring the dividends, interest, or even the margins into the customer's account, that is what is a big risk that is faced by the customers, which is being looked at as a custodial risk. And we also look at the other case, which is called as rehypothecation, another important mechanism which is creating additional risk. Okay, let's say a collateral. I have pledged this collateral with Mr. A, with the company A, some set of securities that are pledged for a borrowing purpose. Now what A could do is, it can repledge these securities. Let's say it can repledge these securities to B and it can raise money. So whatever are the securities that are pledged, they can repledge it and borrow the money to fund its own operations. So in some cases, when the whole chain gets disturbed, at the parties at either of the parties at any of these positions in the chain, they are getting more and more exposed to risk. So this is one of the prime scenarios that resulted in a big downfall to Lehman Brothers also. So even this rehypothecation is one more variant of the counterparty risk itself. So the three major variants which you could see with respect to the counterparty risk is a double default risk, a custodial risk, and even a risk that is associated with more of a rehypothecation. Right? Now we will look at one of the most important models to evaluate the credit risk, which is a Merton based model, which is called as a structural credit model, a structural risk model, because it takes the balance sheet structure of the firm. From the balance sheet structure, we try to evaluate the credit risk involved in the credit risk involved with the firm. So it uses the assets of the firm, the debt of the firm, and the equity of the firm at different points in time. Means it takes the market based values rather than the book values, and based on that it tries to find out all the right from the finding out the value of the firm to value of debt, value of equity, computing the default probability. All these things can very well be done using this model. But of course, one thing is it uses the option pricing approach, the Black-Scholes option pricing approach we have, right? Wherein for a typical option on an equity security, we said that the price of the call option is the spot price of the security into some normal distribution D1 minus the present value of the strike price into ND2, wherein we have defined D1 and D2. D1 we have defined as log S by K plus R plus sigma squared by 2 into T divided by sigma root T, and we have defined D2 as D1 minus sigma root T. This is what we had as a part of the option pricing formula, the Black-Scholes option pricing formula. So even this Merton model to compute the credit risk was using this similar concept. So what are these? So here we have to try mapping this S and all that stuff. Now what they have said is this C is nothing but the value of equity. This C is being taken as value of equity. So value of the call option is nothing but the value of the equity. So the assumption is equity is considered as a call option on the firm's assets with a strike price equal to the value of debt. Now think of it. In general, the equity investor, whatever the payoff they are going to receive, it is nothing but the maximum of the value of the firm minus the value of the debt, or sometimes they will not receive anything. So if the value of the firm is greater than what has to be paid to the lenders, they are going to receive more, the difference. Otherwise, they are going to receive 0. So this is what is a payoff that comes to the equity investor. So that is the reason it can be modeled as a call option also, because the typical definition of a typical payoff of a call option also is the maximum of difference between the stock price and the strike price, comma 0. So I can very well equate these words. The spot price, I am equating it to the value of the firm. The strike price, I am equating it to the value of the debt. Now, here I can also talk about the risk-free rate of return. The sigma, I have to take it as the volatility of the firm. Very difficult to find in the real world. Volatility of the assets, volatility of equity can easily be found, but finding out the volatility of the firm will be a difficult issue here, right? And whatever we are talking of, the expected return on this security, it is making an assumption that the expected return on this security and the market value of the assets, they are fully related. So the risk premium is nothing but mu minus r. That is what is being, so risk-free rate of return, and if this is the return that is actually coming on this security, this excess is purely because of the risk premium. And here a few more assumptions are coming out, that the equity which we are talking of is purely in the form of common shares, no other convertible bonds or preference shares, no other further classification. So the debt is treated as one single zero coupon bond, and equity is treated as common share. So it is making an assumption that the company does not have any other capital structure. It's a very simplified capital structure, whereas in reality today we are seeing more and more complex capital structures existing with the firms. But this model assumes that the capital structure is quite straightforward. Debt is nothing but it's a single zero coupon bond with a value, with a notional value equal to the value at a particular point in time, and the value of the equity is completely in the form of common shares itself. And it is also making an assumption that the debt holders have no recourse. They cannot they cannot go to the claims beyond the value of the collateral. And the debt holders, it is also making an assumption that the debt holders need to be fully paid after the equity payment happens. But in real world, what could very well come out is some kind of negotiations will happen in terms of the debt investors and equity investors as to how to distribute the overall liquidated value. It may not be the case that after the debt investors are fully paid off, the equity investors may receive their part. It may so happen that the distribution is negotiated between the two, and the loss absorption happens accordingly between the debt and the equity investors in the real world. Whereas this model assumes that only after the debt investors are fully repaid, the equity payment will come into picture. And it also assumes that the trading happens both for assets as well, both for equity as well as for debt, but along with that the trading happens even for the assets also. And it believes completely in this model. This formula is applicable only to European options, which means if I have to apply the same concept here, it means that the loss occurs only on the maturity date, not anywhere in between. The risk occurs only on the maturity date and not anywhere in between. So in this overall scenario, what we could see is if the value of the firm is greater than the value of the debt, the difference between the two is what is received by the equity investor, otherwise it is zero. So the default is bound to occur. Default, we are saying that the company is getting into a default position when this is negative. So by how much extent it is negative is what we call as the distance to default. So logically we are saying equity is a call option on the firm's assets where the strike price is equal to the value of the debt. And similarly we can very well write the debt as an investment in a zero coupon bond. The debt is nothing but a zero coupon bond plus a short position, right? We can take the short position on the firm's assets, short put position on the firm's assets with a strike price equal to the value of the debt. So this is how we can consider the equity and debt in the form of options. And as we know, the value of the firm is nothing but value of equity plus value of the debt at any point in time. So I can very well write out, okay, how do I write the value of the equity here? The value of the equity is nothing but the value of the European call option on the bond, plus what is the value of the debt? A zero coupon bond. Zero coupon bonds, the present value, let's say if D is my debt, the present value is DE power minus RT, and a short position in the European put option with a strike price equal to D itself. Here also strike price is equal to D. European put option strike price is equal to D. So this is how I can compute the value of the firm or value of the total assets of the firm. So each individually the debt, so the equity is, the value of the equity is nothing but the value of the call option, whereas the value of the debt is nothing but the present value of the debt plus or minus the maximum of the debt minus the value of the firm, comma 0. So this is like a short position on the assets of the firm with a strike price equal, short put position on the assets of a firm with a strike price equal to the value of the debt. So this is one way we can find out the value of the debt and value of the equity and the value of the firm using this Merton model. And then we are talking about the probability of default. Now in this case, the probability of default is nothing but I can get directly from a normal distribution equation, a standard a standard normal distribution equation function. The probability that the value of the firm is less than the value of the debt is nothing but I could very well take pi of minus d2. I could take that, and that is what is we talk about the probability of default, right? Because we are talking about, whenever we say the probability of default, it is the probability that the put option as well as the call option, both of them are getting exercised. That is what we are calling as the probability of default. So it can come out as the standard normal distribution function of minus d2, which works out as the pi of minus log value of the firm divided by value of debt plus mu minus sigma squared by 2 into T divided by sigma root T. So this is what is coming out as the probability of default. It's a straightforward formula itself, which is resulting in the probability of default. Now, using the same approach, right? If I'm going with the computation of yield to maturity for the same, now we know that okay, whatever the debt, right, whatever the debt that has to be repaid at a future date, e power minus whatever y1 into t should be equal to dt. So based on this, I could write my d is nothing but whatever is the value of the debt right now multiplied by e to the power of y1 into t, where y1 is what I am talking about as the yield from this point till the maturity date. So from here I could very well write my dt, which is the value of the debt at this moment, is nothing but the present value of see, it's like the value of the debt as per the Merton model is nothing but risk investing in a risk-free security plus a short position in a European put option with a strike price equal to the value of the debt itself. So we are saying this minus the European put option, whatever is the value. So this into e to the power of y1t, this is what is coming out as d. So from here I can very well look out, right, e to the power of y1t. So I'm taking, so this entire thing is becoming equal to d. So I will take logarithm log d is equal to, now when I am taking the logarithm of this entire thing, it is becoming y1t times de per minus rt minus the European put option value with a strike price equal to d. So from here I can very well find out my y1. y1 is coming out as 1 by t log d, right? Y1 is probably I could write it like this. Y1 is nothing but 1 by t log d divided by d power minus rt minus the value of the put option. So from here I could find out the value of y. Right, from here I can compute the value of y, which could very well result in 1 by t times the log 1 minus e power minus rt into d plus the price of European put option. So this is how we can compute the yield to maturity from this equation. And subtracting R from both the sides is giving me the credit spread associated with this kind of a Merton model for this particular kind of security. So even using the Merton model, I should be able to compute the yield to maturity as well as the credit spread. And along with that, I could even get into the computation of the loss given default. Now the loss given default, probably from the expected default loss, right? From the expected default loss, I could go with the loss given default because the expected default loss is nothing but whatever is the value of the put option right? Expected loss. I'll get it as the value of put option multiplied by e power RT. I mean, at that point in time in future, what is the expected loss? And this expected loss divided by the probability of default is what is giving my loss given default in terms of dollar value. And this divided by the actual value of debt will give me the loss given default in the percentage terms. And 1 minus loss given default in the percentage terms is going to give me the recovery rate. So now what we could see in this whole process is using the Merton model, I should be able to compute the value of the debt, value of equity, value of the firm, probability of default, the loss given default, get into the processes of the yield to maturity, the credit spread, recovery rate. Almost all the elements can quite comfortably be computed using this Merton model. But of course, there are some kind of drawbacks and assumptions, as we have already seen, which are not so realistic. But at the same time, it can also result in firms with generally high leverage. This model can result in probability of default being very low and recovery rate being very high. But in reality, a firm which is having a high leverage, the probability of default should be much higher and the recovery rate should be much lower. So some kind of limitations do exist in this kind of models, but what we are simply looking at is these models are very heavily used as a part of various other proprietary models like KMV or the credit rating models and all that stuff. But finally, the two major drawbacks is one, the capital structure. It assumes that the debt is a single zero coupon bond and the equity is only common stock and nothing else. So even that is tried to be addressed in some kind of the other proprietary models, wherein they were ready to incorporate slightly complex kind of models, also complex kind of credit capital structures also into their model. And it is assuming that the model was assuming that the volatility of the assets is known from the market, but the other models, they are trying to address this weakness also, saying it's not that easy to observe the value of the firm asset as well as volatility on a regular basis. Apart from that, all the other things associated with the Merton's model are quite effectively used, and it forms a basis for computing the credit risk for various entities. All right. Now let's focus on another aspect relating to the credit risk, which is a credit factor models. The earlier one we have seen are structural based models, but this one is associated with a credit factor model which try to link the loss to the fundamental economic quantities like an index. So there is a linkage between the losses across the various periods with some economic variables. So one such thing, just like your CAPM model is being used to link up the return on an asset with a return on the market. Similarly, here the credit loss is being linked up with some fundamental economic quantities. So it means it's as good as saying as long as the value of the firm is less than the value of the debt, we can treat that a default is going to occur. Now, the other dimension I can look at, let's say I'm looking at the return on an asset. So here we are talking about asset returns. Let's say the return on the asset, right? I'm looking at it as probably the final value, right? The return on the asset is nothing but the final value of the asset minus the current value of the asset divided by the current value. This is what is the return. But if I want a continuously compounded kind of a return, I can take the logarithm of this same, right? So for this period, I'm looking at the return as the logarithm of this particular value. And as we know that if the value of the firm, probably in this case is AT, if it is less than the D, the value of the firm at time T is less than the value of the debt, that is where I am calling it as default. So from this dimension, it is also coming out that the AT should be less than, all else remaining the same. Instead of AT, I will substitute D minus AT by AT, correct? Which is nothing but D minus AT is working out to ET with a negative sign. So this is coming out as minus log the current value of equity to the current value of assets. So now what is it talking about? If the asset returns is lesser than minus logarithm of the equity ratio, that is what is an indication of a default. The other way we are talking of is if the asset returns are negative and greater in absolute value compared to the initial equity ratio, that is the time we say that the default is going to occur. So that is how the assessment of the default and the asset returns are linked as a part of the credit factor models. So it may link probably the market risk or an index or any such kind of betas can be brought in to assess the return on the asset as well as the variance of the asset returns also, right? Now one more mechanism that is used to assess the credit risk is the credit value at risk. Probably whatever the structural models which we have used earlier, whatever the factor models which we have used earlier, there is a lot of relation to the credit VAR. The reason being both all of them are targeting the losses, perceived or potential losses at a future date with some level of probability, right? How much losses, see what is the chance that the loss will be more than 10 million in a single day. So what we could typically see is whether it is VAR or the structural model, the Merton based model, they are all targeting towards the probability of loss and the loss given default finally resulting in the expected loss itself, right? But the main thing what we see is when we talk about a credit related risk, the time horizon will be much larger. For a credit risk, we generally talk about the default over a 1 year, 2 year kind of period, whereas that's not the case with respect to the market related risk. We may try to look out on a shorter time frame for market related risks. And also there is a lot of skewness in the market related risk. Probably the returns are expected to follow more or less a normal distribution, whereas in case of credit risk we see that the skewness is very high. The reason being, see if the probably the probability of default, it may be very rare. For an event, a probability of default may be very small, means it's very rare to default kind of an event. But if the default occurs, let's say the loss is going to be very severe. Now what you see is, when you try to represent your losses in a distribution, you will get a very big negative tail. The tail is very heavily negative. So that is where the skewness becomes much higher. So that's the reason to compute the credit value at risk, we are taking a very high confidence level, generally to the extent of 99.9 percentile confidence level is what will come out to our computation of the credit risk because of the heavy skewness involved in the model. Now, whenever we talk about any credit loss, we are talking about three components. Okay, this is the average part, which is talking about my expected loss, which is given by probability of default into loss given default into exposure at default. Then we are talking about this 99.9 percentile part, which is called as the unexpected loss, which is okay, what is that cutoff point beyond which the chance of the loss occurring is just 1.1%. So we are talking, so the expected loss is coming out purely as this, which is nothing but the difference between the par value and the expected future value of the various payments that are coming on this particular bond. Whereas this unexpected loss is purely that 99.9 percentile quantile, which is in excess of this expected loss. And what we are simply saying is the difference between the unexpected loss and the expected loss is what we are calling as the credit var unexpected loss. So it is this particular point over a specific time period minus the expected loss. This is what is coming out as credit value at risk, right? And of course, something beyond this particular amount is getting classified as the tail loss. The tail loss is the loss even beyond the unexpected loss itself. So this is how the credit var needs to be computed. And on the other side, there is also a mechanism that is being looked at in this case called as jump to default risk, which is like, what if a company defaults right away? What is the amount of loss that is going to occur? So we are not even talking about a probability of default or any of these things here. Immediately, if the company is going to default, if the issue is going to default, based on the recovery rate, whatever can be recovered right now, what is the amount that is still at loss? That is what we are calling as jump to default risk. Sometimes it is used as a worst case scenario in the stress testing mechanism, which can help us in assessing the credit worthiness of the particular investment or instrument. So these are the various aspects in a nutshell that cover this credit and counterparty risk. Initially, we started with trying to understand the various types of instruments that could lead to credit risk, understanding book value versus market value, then understanding the various types of instruments, including the debt instruments and debt plus equity hybrid kind of an instruments, as well as the equity instruments. Then we also discussed something about the frictions that can exist during the creation of the credit products. And after that, we started our focus in terms of defining the default, the recoveries, various definitions associated like probability of default, exposure at default, the loss given default, the recovery rate, all these kind of definitions, and the motivations behind going forward for a lending, even if it is known that the risk associated with the lending is higher. Then we are trying to look out for various credit assessment techniques using the ratings approach and the different kinds of models. got a brief introduction into the counterparty risk and the various variations with respect to this counterparty risk, and had a small understanding about the structural models, especially the Merton model, how it is used to value the debt, the equity, how do I compute probability of default, what are the major limitations associated with that, slowly moved towards the credit factor models, and finally ended up with this credit VAR. So this is in a nutshell the understanding of the credit as well as counterparty risk. If there are any further queries regarding that, you can very well get back to me by giving me a call on the number that I have provided here, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.